Okay, the third part of this chapter 2. We're going to look at the trial balance. We're going to look at all the entries that we've made and combine them into the fourth type of format, which is a trial balance. So we'll look at the accounting process, just kind of have a word about debits and credits and where they should balance, and then look at the trial balance. Okay, let's go ahead and move into this. So what I've done here is reproduce all 10 transactions that we looked at in the previous 2. So I have taken, if you remember the first 5, this was the investment by the owner, a loan, we bought equipment with cash, we bought inventory on account. At the end of the month, we paid down some of that account. Here's a cash sale. Here's the inventory we used for the cash sale. Here's service revenue, meaning no cash. We paid rent and we took a drawing. And if you go back and listen to the explanation of them, or you can see here, I've written down the debits and the credits for each of these. So the process is to first take a look at what is the business transaction and try and figure out what is the journal entry. So all of these are journal entries. Now you notice for every journal entry, it follows our rule. There's at least 2 parts. There's a debit and a credit, and the debits and the credits must equal. Now I haven't put them on the accounting equation, but once we get knowledgeable enough about debits and credits, we realize the debits and credits equaling ends up substituting for the accounting equation. If the debits and credits equal, unless it's a very strange situation, then the accounting equation equals. So here are 10 transactions. Here are the 10 journal entries, all the debits and credits equal. Now what we do from here is we go to the second stage where we take each individual transaction. These could have happened over the month, and we're going to break them apart. This format, the journal entry format, is looking at every transaction individually. This is one transaction, this is another transaction. But if I wanted to know what are all the cash parts of all the different transactions, so what we do is we post this to the ledger. And in this case, we're using a simplified ledger, meaning we're just going to use T accounts. So what I'm going to do is, here we have 10 different T accounts. I'm just going to take all of these journal entries and put them on the T account, so that rather than looking, it's all the same information, but rather than looking them at a transaction level, we're going to be looking at them from an account level. What were all the cash transactions? What were all the inventory transactions? What were all the revenue transactions? And some of them will just have one because we only have 10 things. So here we've got a debit to cash and a credit to capital. So cash, capital. Number 2, we've got the loan was a debit to cash and a credit to a note payable. The third one was buying equipment. So equipment went up and cash went down. Fourth one was inventory went up by 500, and we bought it on account, meaning we didn't pay yet, so our liability went up. At the end of the month, we decided to pay down some of our liability by 100. So we paid down the account by 100, and we used 100 in cash. Number 6 was we had $600 in cash, and that was because we did a sale. So revenue went up. Now, what did we sell? We sold $300 worth of inventory. So inventory went down by $300, and our expense, our cost of goods sold, our expense went up by $300. The next one is we sold services. We performed services, so no cash, but we did it on account, meaning the customer was going to pay us later, and that was $700 on account, and our revenue went up by $700 as well. We paid rent. So rent we paid in cash. So we paid $200 in cash, and our expenses went up by $200. And the last one is we took a drawing of cash of $400. I didn't quite give myself enough room here. But if I were to subtotal all this, you can see this side, I'll kind of write it off here to the side. This side totals up 3,600. And this side totals up 4, 5, 6, 7, 8, 1,800. So what it ends up being is that we have a positive 1,800 left in our cash account at the end. We only have one item in the capital account, one item in note payable, equipment. We have two items in inventory. So what's our value in our inventory account at the end? It's 200. What is the value in our AP account? It's 400 on the credit side. Revenue, we had two entries, a total of 1,300. Just 700 for AR. Our expenses went up by 500. And our draw was 400. And, you know, it might be worth just going through and identifying which types of accounts these are. So cash is an asset and therefore increases with a debit. Owner's capital is an equity account, so increases with a credit. Note payable is a liability, so increases with a credit. Equipment is an asset account, so increases with a debit. Inventory is also an asset account, so increases with a debit. AP is a liability, so increases with a credit. Revenue is similar to equity, and it's its own account, and it increases with a credit. AR is an asset account, and therefore increases with a debit. Expenses are their own type. Now, normally we would write it out as one would be rent expense, the other one would be inventory expense, which has its own name, cost of goods sold. But here we just put them all together. And so expenses increase through a debit, and drawings also increase through a debit. So we have seen these are the business transactions. Previously, we had looked at it from the accounting equation point of view. This is what it looks like from the journal entry point of view. It tells the same information. Debit, credits, tells us increase or decrease, tells us the amount. Now, notice here in the journal entries, the debits must equal the credits. Each individual transaction, the debits must equal the credits. But when we break them apart, the debits don't equal the credits because there has to be almost always there's got to be some sort of balance in the account, meaning there's got to be a certain amount of money or a certain amount of value in each account. So because what we're doing here with the T accounts is we're breaking apart the journal entries, it doesn't necessarily mean that any particular T account that the debits will always equal the credits. In fact, that will hardly ever be the case because this is the information that we're needing. You know, if we want to say how much was our revenue this time, well, this is where we find out the information. How much is our cash at the end of the month? And it's important to realize that even though any individual T account is not balanced, all the T accounts together should balance because all the T accounts together come from all the journal entries. All the journal entries individually balance, therefore the total amount of T accounts should balance, and that's what we're going to test next. The important thing here is to make sure that you have a balance at the end of the month or the end of the accounting period for each one. What we're going to do is we're going to now take this information, because remember, what is the whole reason we're doing this? We're trying to record business transactions, then summarize them so we can put them in the financial statements. So here are the individual transactions. We've done one step of summarizing by putting them into accounts. Now, when we put it into the financial statements, we're not going to put in the financial statement on the balance sheet. We're not going to put all the individual up and down in the cash. We're just going to put the ending balance of 1,800. Did I get that right? 4, 5, 6, 7. I think so. Just came out to 1,800. What we're putting here is the ending balance of inventory, not the up and down. So how do we do that? Well, we transfer these amounts to something called a trial balance. And now the trial balance is basically taking the balances of these T accounts and putting them here. So if I was to look at cash, my cash has an $1,800 debit. My AR has a $700 debit. My inventory has a $200 debit. My equipment has an $1,100 debit. My accounts payable, what I owe, remember I started off by putting stuff on account for $500, but I did pay off $100, so I still owe $400, and that's a credit. My note payable, how much do I owe on my bank loan? I still owe $1,000. How much investment from the owner? It was $2,000. How much did we draw out of the account for our own? How much did the owner draw out of the business for their own use? $400, and that's a debit. And then revenues were $1,300 credit. And my expenses were a $500 debit. Now, if I've done this correctly, all my debits should equal all my credits. So let's see, we've got 3,300, 3,400, 3,800 here, right? And what do I have here? 9, 1,100, 2,000. Ooh, did I do something wrong? Okay, I scared myself, but I found my error. Okay, so I looked at this as 100, but it's actually 1,000. So this number is incorrect. I double checked my math, and I was starting to scare myself. So instead, we've got 2,000, 3,000, 4,300, 4,700, right? Here we've got 5, 9 plus 1,100 is 2,000. Plus 1,800 and 200, that's 4,000, plus 700 is 4,700. Oof. So notice my debits do equal my credits. Wasn't paying. I thought this was 100 and just was mentally adding it up. So notice here in my trial balance, my debits do equal my credits. And you may not have noticed that because my trial balance is just taking the balances of all the T accounts. And what we said was, if all the journal entries balance, and then we break them apart and put them into actual accounts, any individual account may not balance, but all the accounts should balance together because they come from the journal entries. And that's what the trial balance is. The trial balance is just taking the end of month balance, whatever the summary is in each T account, and putting it on a trial balance. Now I put it in this order for a particular reason, because, well, you'll find out that we still have a little bit more to do, but this order allows us to transfer this stuff directly to the financial statements. Here are the income statement items. The drawing goes on the statement of owner's equity, and these are all balance sheet items, but specifically these cash, AR, inventory, and equipment, these are assets. Accounts payable and notes payable are liabilities, and this owner's capital is equity. So remember, that was the whole purpose of this project to begin with, is we have financial statements. How do we put information into the financial statements? First, we look at each individual transaction, turning it into a journal entry. We take all those journal entries, we take all these journal entries that are individual transactions, break them apart and list them on their T accounts. We take the summary of the T accounts and we put it on the trial balance. We double check to make sure that the assets equal the debits equals the credits. And I have done it in an order that allows us, once we've confirmed that the debits equals the credits, I can then create my financial statements using this information. And that's how we go from business transactions to creating the financial statements. And that is Chapter 2. Okay, if you have questions, let me know. Thank you.